Great to be here. We're going to just do a quick market update to kick things off, starting with the public markets. That's the NASDAQ right there. Pretty good year in the public markets. It was up 13%, sitting at an all-time high, like pretty much all of the U.S. markets. But if we dive into our subsectors, MarTech, very strong year, up 72%. Most of that, again, on the back of Shopify now sporting over a $30 billion market cap. And speaking of multi-billion-dollar market caps, the Trade Desk also very strong year, up 82%. And even AdTech beat the overall index. And it wasn't just price performance that was strong this last year. Look at the multiples. So MarTech almost at 10x as a category. Certainly Trade Desk kind of in a category of one there. But AdTech trading at 3.3 times. I think the days of the sub 1x ad tech multiples are hopefully behind us. In fact, as we drill down a little bit on ad tech, there's really only one of those players that had a bad year. Criteo trailed the market. But if you take them out of the index, the other three up over 100% collectively. So kind of a rebound in the ad tech sector with those multiples over 4 times. So strong price performance, strong multiples usually makes for a pretty good IPO market. And we were talking last year, I think, about the pending stampede of unicorns getting ready to hit the markets. We did see a number of those get out last year. The post-market trading performance was decidedly mixed. I think 2/3 of those players trading substantially below where they priced, even causing some, okay, maybe really one, to withdraw their prospectus. Might have been a little more about, as our good friend Scott Galloway pointed away, less about market dynamics, more about challenges in their business model. But we saw WeWork retreat. What do we think that means for the pipeline? Still a number of companies eyeing the markets. I think this enhanced scrutiny of business models will likely continue. Those businesses with solid fundamentals we think will be just fine, which candidly is the way it should be. But, you know, all this kind of a little bit of backdrop to the market close to our hearts, the M&A market. Like this chart, it continues to be the primary source of exits. Look at that last 4 quarters up and to the right. So continued growth there, and really sizable deals continue to increase. So up almost 20% over last year with deals over 100 million. MarTech being the hot spot again. Particular strength there. We saw a number of high-profile deals in MarTech, including 5 over $1 billion, representing over $25 billion of value. So it was kind of the MarTech year. We called this last year. LUMA declared, 18 the year of MarTech. I'm not saying we got that wrong. It was a good year, but we might have been a year early. If we look at this year already exceeding last year, and if you annualize that, we're certainly heading into record territory in the sector. Why is that? Really good buyer dynamics. We talked about the expanding universe of buyers in MarTech. Certainly among the marketing clouds, a number of them continue to be active. We like those dynamics. Private equity is the single biggest buyer in the category. So those are the usual suspects. But last year we saw the digital giants get more active. Deals by Google, by Apple, by Microsoft. And interestingly, brands taking technologies in-house. I can't say that we predicted that McDonald's was going to be a multiple buyer, serial buyer in the category. I think it's prompted a number of our clients to ask, well, shouldn't we be calling Burger King next? And you're not sure where that goes. But overall, very encouraged by the activity in the space. So let me hand it back to Terry. Thanks so much.
Thank you, Mark. So, okay, we got active equity markets. We've got a very active M&A market and rising. Let me tell you something. That's not happening in utilities. All right, let's talk about some of the things going on in the ecosystem. Convergent TV, it's on everyone's mind, right? It's all everyone's talking about. There's a lot going on here. Think about it from the perspective of big media, right? The folks, the incumbent folks who have been for the last 60 years reaping huge profits from this very large and historically reasonably stable industry sector. Well, not so much anymore. Look, you're all familiar with the calls for the death of TV. It's been sort of 10, almost even 15 years now. We've been told that TV is dying, and yet, and there's some clear evidence of that, right? If you look at linear TV viewership, it is in secular decline. Now take a look specifically why we parse out the demos to see the younger, more attractive advertising audiences are way down. They're down 25 to 60% just in the last 10 years. So, right? So obviously it's true, right? The rumors are true. It's dying. Well, linear TV is demonstrating an incredible elasticity of demand. Remember when you took that economics course and they drew those funny demand and supply curves and where they intersect, that's where pricing is? Well, let's think about what's happened in TV. They restrict supply because the viewers are less, and what do? They just jack up the price. And that is exactly what has happened because revenues are largely flat in television. By the way, they're likely to remain strong and flat-ish. So what's going on here? What are the catalysts that could change this dynamic? Well, if we think of the comparative advantage of linear TV, we think of live, because turns out that time spent watching linear TV is dominated by live. When we think of live, it turns out when you double-click, live really is a proxy for sports. Sports is the majority of live viewing. And then when you double-click into sports, it turns out that football is really what we're talking about here. So the NFL holds the keys to the linear TV kingdom. And so that then had us take a look at, okay, and what does that landscape look like? And it turns out that in 2022, we're going to have a major, that's when the expiration date of the major broadcast rights for the NFL. You got to believe that the parties are in conversations today in anticipation of that time period, because that clearly could be a catalyst. I mean, think about it. If Google were to buy the rights, or Google or an Amazon were to buy the rights of the NFL, that would be the anvil that broke the camel's back, if you will. But look, 2020 is going to be a good year, right? It's an Olympic year. It's an election year. Election alone is $10 billion in additional ad spend. So I'm pretty sure we're going to be fine in 2020, but think about 2021, right? No election, no Olympics, no World Cup, and contract renewal of major sports broadcast rights coming up. So all eyes are on 2021. What is big media doing in response to this? Well, they're bulking up, right? Whether it's a content-to-content deal, a horizontal M&A deal, or distribution-to-distribution, or a vertical play where distribution and content marry up. In total, we have seen over $200 billion worth of M&A activity as the incumbents try to garner some scale in anticipation of the coming fight with digital. Speaking of which, the digital perspective, they look at things very, very differently, right? For the digital folks, you know, this is a channel that has now surpassed TV. It's a couple years now. It's been the largest media and advertising channel. We all know how that has flushed out, with 2/3 of that channel being dominated by 3 companies, the triopoly. And yet, if you read the recent IAB PwC report about the first half of the year, we are starting to slow. Growth is slowing. It is still a growing sector and will continue to do so for some time, but the growth is starting to slow. Well, what are these giants doing as a function of digital starting to slow and changes happening in TV? Well, they all have their sights set on that a massive amount of spend. Not, by the way, not just the $70 billion in advertising. Don't forget the $80 billion of pay. It's a $150 billion prize that they're all going after. So big tech's got their sights set on TV. The incumbents are, you know, trying to prepare for battle. And I will tell you one thing: it is not a fair fight. The combinations that traditional TV have done to bulk up. You see several players over $200 billion. Woohoo, way to go. Well, they pale in comparison to the digital giants that not only have larger market caps, they trade at higher multiples, they have way more cash. This is not a fair fight, ladies and gentlemen. And as you've seen us talk about, the battle is here. It's on with decidedly, you know, different tactics. Clearly, the digital giants are on the offense, spending lots of money on content and focusing on the user experience, whereas the incumbents, both the content and distribution companies, are really relying on sort of regulation to try and help them, and they're by necessity going to need to do M&A in order to garner the capabilities that are inherent with the digital giants. And we all know the streaming wars are heating up. We've had a variety of consumer options for consuming TV content over the top, and you've undoubtedly, whether it's billboards, radio, television, digital, you've been bombarded with all these campaigns of the launch of all these new streaming services. This is an all-out war. This is what traditional media believes they need to do to change the consumption patterns to match the proclivities of the consumer. And they're ensuring the absolute success of these rollouts by essentially making it free, right? The promotional campaigns that they've run, the bundling that they've done is basically going to ensure the successful rollout. And with Peacock going potentially free to everyone. I gotta say, well done, traditional TV. They got their act together. And you know, for the very first time, we've always talked about the dominance of Netflix, but you can find research analysts that are talking about Netflix going to zero. I don't believe that's going to happen, but just the notion that it could because of this newfound competition is really a turning point. And let's face it, all wars have casualties, and there's no question the streaming war will have casualties along the way. Just last week, we saw 2 such casualties, Sony announcing they're shuttering PlayStation Vue, and Walmart putting Vudu on the sale block. If any of you are thinking this is not good for advertising, fear not. There is no chance that the middle of America, and once you get down below the top demos, that all Americans can afford umpteen different viewing SVOD options. There will in fact be a significant advertising opportunity in this over-the-top world. NBC is already recognizing that with the announcement that Peacock will be AVOD. And the projections for the AVOD spend category are set to be pretty substantial. One of the things we know, one of the challenges with this new world of what we call convergent TV, not connected TV, convergent TV, because think about it, to the consumer, right? They don't care whether this is linear over their set-top box or satellite, or it's over the top from IPTV, or it's digital, on their phone. They just want to consume their content across a variety of devices. For the marketer, this creates a headache. These are 4 fundamentally different sub-channels within convergent TV. So how do you do things like measurement? How do you plan? How do you buy? How do you attribute and coordinate across all of those different channels? Well, we're going to have conversations about those types of capabilities, and there's folks in the room that are addressing that very issue. And one of the things that's very clear is, for the incumbents, there's another reason why not just are they bulking up in terms of M&A, they're also cooperating on data, because when you compare yourself to someone with 2.5 billion known users, you need all the help you can get. Speaking of data, so we're super excited about what's happening in CTV. We just announced the sale of Clip to AT&T 2 weeks ago, and I got to tell you, the level of conversations around future activity in CTV is off the charts. So we're very busy on that. Data and privacy, real non-issue. Next. No, just kidding. Look, it's no surprise the digital ecosystem is facing challenges. And it's been called a techlash, right? The backlash against big tech on things like platform abuse and brand safety, consumer privacy, and antitrust. We're now a year and a half into GDPR, and we're a couple months away from CCPA, plus a variety of other states. So we know this is a major issue that the industry has to contend with. Oddly, some of the reaction from the largest players has been to restrict, under the name of privacy, pull back their data, which obviously is a double-edged sword, has an implication on antitrust. Speaking of which, we now have 48 AGs investigating, Google, Facebook, all the big guys around their practices, because I think we have to have a fair, it has to be a fair fight. So I think that's prudent and appropriate. So where do we go from here? Where does that place us? Well, we've sort of witnessed, the pendulum sort of swing in a variety of directions, right? We've seen the challenges of the misuse of data, but we're pretty convinced that that's bad, right? So we need a fix to that. And so our regulators have gone in and are making lots of noise, but we just simply believe that we cannot go back to a Wanamaker world where we don't know who it is to whom we are marketing to. So there has to be some middle ground, right, where, yes, the privacy rights of consumers are respected, and by the way, it's going to be better for business anyways when you have a direct connection with the consumer. You've heard the term first-party data, or third-party data, but with appropriate consent. So there's no looking back. This is the new reality, and it's a good thing once we get past this, like ripping off a Band-Aid, and then we hope a lot more effective marketing when you have that deeper connection. Brian.
Great, thank you. So I'm in my 10th year of partnering with Terry. I had no idea about the energy background. I started my career first 5 years as an engineer in oil and gas. So actually we had some similarities way back in our early days. So Terry just talked about some of the dynamics about why there's an increasing focus on first-party data. So wanted to talk about one category in particular that's still the hottest category from an investment and an adoption perspective, and that's the CDP category. So we still see a lot of VC investment coming in. We've seen $750 million coming in since 2017. And the leaders in the category are still growing at exceptional growth rates. But we have seen, or we continue to see, a lot of confusion about the category. These logos represent all the logos that are listed on the CDP Institute website. And I focus on the space. I look at this, and I don't know at least half of these vendors. A lot of them are international, but there's also vendors in here that I know well that I'd say, well, they're not CDPs. So if you're a marketer trying to adopt something and you have this wide variety of companies that have very different solutions, you will be confused. That's why you do see, Gartner mentioned that CDP is a #1 inquiry category by marketers. It's my personal #1 inquiry area from buyers, saying this looks super interesting. There's a lot of high growth companies, but I am totally confused. So what we did is, this is a graphic we've started to use in our conversations. It's inspired by multiple conversations or graphics in sales decks. You can see the companies on the right, top right. But this is really taking, it's very simple. It's taking the Gartner flow chart of ingestion all the way through execution and flipping it sideways into more of a marketecture diagram. What we found it's really useful to talk about when you're talking about companies. So let's look at kind of both ends to start. So you have a company like Segment. What are they? I mean, they just raised $175 million at a $1.5 billion valuation earlier this year. And they're a data connector. They integrate with lots of different systems. They move data back and forth. They're very good at that. So they really reside in that bottom box. On the other end of the spectrum, you have companies like Evergage. Evergage was recently named the #1 personalization engine in the category. All the personalization is driven by the user profile, so they are a CDP, but why do they win? They win because of their execution apps. Another company, Amperity, that the CEO is on the CDP panel, they really focus on identity resolution. So the #1 outcome marketers are looking to get when they adopt a CDP per a recent survey is to get to a clean profile for each and every consumer. So that's what Amperity had been focused on. But what did they just do this week? They just merged with Castora. What is Castora focused on? They really focus on decisioning and orchestration. So now they've been able to extend their stack. And so we're happy for any of you that are CDPs or interested in CDPs. Love to chat with you about this, where you reside or where you're looking for. But we found this to be a useful tool for ourselves in our conversations. So a lot of people know LUMA for two things. One, our industry focus and expertise, and our M&A execution. So our presentations, usually are really focused on industry trends, just like Terry went through. We thought we'd focus more on the other side of the equation and do some case studies. So not really M&A execution, but how businesses can transform their businesses through M&A. We wanted to go through two particular case studies. Before we do that, we wanted to set the kind of the backdrop of, why do companies do M&A? Well, it's obviously to increase shareholder value. Everything they do as a business should have this goal in mind. So what are those underlying drivers to increase valuation? The way we look at it, for the independent value of a business, there's really three drivers. Growth, how fast is it growing? Actually, more importantly, how fast is it going to grow in the future? Operating leverage, so for every revenue dollar that they increase, how much can drop to the operating income line? And then predictability, how predictable is their business? This is why high growth SaaS subscription businesses are so highly valued, because they check all three of those boxes. The other dynamic in M&A is strategic value. What can that buyer do with that business when they plug it into their business? You do see deals where it's almost 100% strategic value. So probably the two most obvious and highlighted ones are YouTube and Instagram. These were businesses, when they were paid, there was a lot of head scratching. Why did they pay so much money? I mean, $1 billion for 12 people with no revenues when Facebook bought Instagram. But recent estimates of if they were valued independently are just staggering. So they're basically 100x, 200x returns on the M&A price tag. So obviously everybody strives for those. Wanted to focus more close to home for this event, two digital marketing businesses and the way they transformed their businesses, Adobe and LiveRamp. So first to go through Adobe. So a lot of people that know me know I came before LUMA from Adobe, and I got to Adobe through acquisition of Omniture. Omniture was the basis of, or is the basis of, their marketing cloud, or actually now their experience cloud, as they call it. So the business was transformed really by two things. One, yes, the building of that marketing experience cloud, but also it's a transformation of the fundamental Adobe business. So we're going to go through both those dynamics. So pre-Omniture, Adobe was a $3 billion revenue business. It has declined 13% in the past year. Not surprising. Look at the year that's in the middle of the recession. It is a $16 billion enterprise business and basically a 5x revenue multiple. So that's actually a pretty good revenue multiple because they had so much pricing power as the leading creative software company. But when they bought us, I have to say, around our exec table, a lot of us are scratching our heads. They're like, all right, I thought it'd be IBM or Salesforce or somebody like that would buy us. Why is Adobe buying us? And Shantanu would talk about, well, it's really the ability to connect content creation with optimization and analytics. It's like, okay, well, I guess that makes some sense. And when you look at the kind of announcements, at that time, the quarter they announced the deal, profits had fallen 29%, revenue slid 20%, 21%. But also the deal itself had a lot of people scratching their heads externally. So you had like the Jefferies analyst drop from a buy to a hold and just said, I don't see material synergy between these businesses. And he wasn't wrong. I mean, these businesses really have been run independently. So let's look at them independently. So the marketing cloud, over 10 years, they've done a lot of acquisitions, been hugely successful, building a business that's now a $3 billion run rate. So this is one of the largest SaaS subscription businesses on the planet and has grown 10x in 10 years. So They have done an awesome job growing a terrific business, both organically and inorganically. But the one that people don't talk to as much is the other side of the house. So again, they sold box software through the retail channel. And what was happening 10 years ago? The movement to the cloud and subscription-based pricing. So I would imagine Adobe could have gotten there eventually, but by buying Omniture, that was cloud-based, subscription-based pricing, they could infuse that know-how into their business. So if you look at their success there, they've gone from basically 0 to 90% of their business being subscription. And then when you look at their stock price, it's really followed that trajectory as well. So where are they today? They're now a $142 billion market cap company, 13x multiple. We tried to see, okay, well, if we separate these businesses, how to be valued? So using a comp set, we came up with, we thought the marketing cloud would be about 11x. So that'd be a $33 billion business. So that results in a 15x multiple for the Creative Cloud, $108 billion. So a 10x improvement in multiple and $94 billion market cap growth. So just a staggering success in the business transformation. Coming back to those value drivers, if you look at where they were and where they are, they did have strong operating leverage, as I mentioned, being the leading creative software business, but everything's improved. Growth has dramatically improved. The operating leverage even has improved, extremely predictable, and that's where we saw the growth from a 5x to a 13x revenue multiple. So just huge, successful transformation of that business. So if we now look at LiveRamp, this is really the migration of being a services-based business to a high-growth technology subscription-based business. So in the transformation from Axiom to LiveRamp. So if you look at the business before Scott Howe got there, information management services with data products, it was declining 14%, and that's the gross margin, not operating margin, 24%. So really recognizing this was a services heavy business. And then the stock price basically declined 50% in the last 5 years, while the general market had grown over 50%. So Scott Howe got there July 2011. A few years later is when they did their big move. They bought LiveRamp. So when you look at what they paid for it, again, there was some head scratching. They paid 14% of their enterprise value for a business that was going to be less than 3% of their overall business, 11 times multiple. And that's rare you see a business pay so much higher than their own business for such a material transaction, but is really about that first-party data and moving into the identity space. Like some of the head-scratching on the Adobe Omniture deal, same thing. Forrester talked about, is it worth $300 million? They didn't think so, too high of a price. But also they questioned, could Axiom sell this product? It didn't deter Scott and team, so they kept going. They've done more than this, but we'll highlight Arbor and Circulate. They bought those two businesses for a combined $140 million, really doubling down on the identity business to increase their match rates. But then you ended up with a hybrid business. So one of my responsibilities pre-LUMA is I was responsible for investor relations for a while. And anybody who's dealt with the public markets realize there's different classes of investors. There's more than this, but there's growth investors and then there's value investors. And now all of a sudden you have a business that has different aspects that appeal to two different types of investors. That's a tough situation to be, because investors look at it as a fish or as a fowl. Do I want to invest? Does it fit my, what I'm trying to do as a fund manager? So they definitely solved that problem, divested the traditional Axiom business for over $2 billion, divested over 75% of their revenues. And a Morgan Stanley study, when they were trying to do a sum of the parts, pre-separation, they said they viewed the market valuing LiveRamp at $500 million, a 2x revenue multiple. Once they shed the Axiom business and it could publicly trade, it traded up to a 9x multiple. So, staggering increase, $2 billion value gained, 7x multiple gains. So if you look at the overall stock price, again, it declined 43% in the 5 years before Scott got there. Since then, 196% growth, 14% annualized. That's even after selling off the last few months. But again, from a multiple expansion perspective, 1.2 to 5.6. Coming back to this chart again, every single aspect has improved dramatically along those. That has really driven that multiple growth. So I see Dave, one of the key guys behind this here, and I know we're going to have a conversation with Scott on stage in the afternoon to hear their side of the story. And this was not done in collaboration with Adobe or LiveRamp. This is our observation. So none of this was fed to us. So we just thought it was good for people to learn and think about what are the value drivers behind their business and what they can learn from it.